Hey guys, this is Kritish and welcome to TradeBen's YouTube channel. First of all, if you haven't watched the part 1 of our frequently used terms in Indian stock market, then you can find the link in the description so that you do not miss out those terms. In this video, we are going to discuss a few more frequently used terms in the stock market. Now, if you are new to this channel, please subscribe. We publish new interesting investing videos every week. So let's get started with more frequently used terms in the stock market. The first is market cap or market capitalization, and it refers to the total market value of the company's share. It is calculated by multiplying the total number of outstanding shares of a company by the price of one share. For example, let's say there are 100 crore shares of a company and each share is trading at rupees 2, then the market capitalization of that share will be 100 into 2, that is 200 crores. Now, market capitalization is used to define small cap, mid cap and large cap companies. For example, if the market capitalization of a company is greater than 29,000 crore, then it can be considered as a large cap company, that is big company. On the other hand, if the market capitalization is between 8500 crores and 29,000 crore, then it can be said roughly to be a mid cap company. And finally, if the market capitalization of a company is less than 8500 crore, then it can be said to be a small cap company. So for the big reputable companies who have been in the market for a long time, like Tata Motors, Maruti Suzuki, HUL, all these are large cap companies. On the other hand, startups or new companies, new businesses, they are generally in the small cap range. And all this division is based on the basis of market capitalization. Let's move to the next term. It is called index. Now, since there are thousands of companies listed in a stock exchange, hence it's difficult to track each and every stock to evaluate the market performance at a time, and hence a smaller sample is taken which is the representative of the whole market, and it is called index. So if you want to know any specific market or any specific sector how they are performing, then you can look at their index. It helps in the measurement of a value of a section of the stock market, and Sensex and Nifty are the indexes of Bombay Stock Exchange, BSE and NSE. So let's understand Sensex and Nifty better. Sensex or BSE 30 is a market index consisting of 30 well-established and financially sound companies listed on Bombay Stock Exchange. So basically it consists of the 30 companies, and if all the 30 companies are doing well, that is the stocks of majority of these 30 companies are doing well and going higher, then Sensex will also go high, and it is said that the market is doing good. On the other hand, if the stock prices of the majority of those 30 companies are going down on a particular day, then the Sensex will also fall, and we can conclude that market is doing bad. Overall, it is an indicator of market movement. The next is Nifty. Nifty is also called Nifty 50, and it is the market index consisting of 50 well-established and financially sound companies listed on National Stock Exchange, that is NSE. Now again, if the majority of the 50 companies are going higher on a particular day, then Nifty will also go high, and if the majority of the 50 companies in the index is going down, then Nifty is going down. And this is what investors talk when they talk about Nifty or Sensex is going high or low. Now these 50 companies are selected on the basis of free float market capitalization. Also, all the big 50 companies who has a very large market capitalization are selected in the index of Nifty 50. The next term is limit order. So limit order means to buy or sell a share with a limit price. So as you already know that a price of a stock fluctuates every second in the stock market, and if you want to buy a share at a given price, your own price, then you can place a limit order. For example, let's say the stock of Tata Motors is trading at rupees 180, but you do not want to buy at rupees 180, you want to buy it at rupees 178. So here you can buy a limit order, and when the price of Tata Motors falls from rupees 180 to 178, this order will get executed. However, the problem with limit order is that sometimes your order might never get executed. For example, let's say if the price of Tata Motors starts moving from rupees 180 to 182, 184, 185 and even higher, then your order will never get executed, and in such scenarios you have to cancel this limit order and again place another order. On the other hand, market order is when you want to buy and sell stocks at the current market price, that is the current share price. So let's again we can go back to this example of Tata Motors. So let's say its current share price is rupees 180 and you want to buy shares of Tata Motors at the same price, then you can place a market order. And the best point about market order is that it is executed instantaneously. The next is margin. Trading on margin means borrowing money from your stockbroker to purchase stock. So let's understand this concept better. Let's say you buy stock at rupees 100 and you sold the stock at rupees 102. So here your profit will be rupees 2. However, this is a very small profit. So here what they can do is they can get a money or borrow money from their broker so that they can buy huge quantity of the stocks. So margin basically helps the traders to trade in more stocks than you would normally be able to. So here the profits earned can be increased significantly. However, as you are borrowing money from the broker, again the risk also increases, because anyhow if you make money or if you lose money, you have to return that money to your broker. The next term is liquidity. Liquidity means how easily you can buy or sell share without affecting the share price. A highly liquid share means that it can easily be bought or sold. On the other hand, a low liquid stock means that the buyers and sellers are hard to find. For example, big companies who has a lot of outstanding shares, for them it's easy to buy and sell stocks. On the other hand, in a scenario where you buy a small cap company who has a very less number of volume and liquidity, you might get stuck with the stock. So let's say you hold 1000 quantity of that stock and there is no buyer there, that is no one is ready to buy that stock from you, then you might be stuck with those stocks. So whenever you are purchasing any company, or if whenever you are purchasing especially small cap companies, then check their liquidity, that is how liquid the companies are, how easily you can buy and sell stocks of that company. The next term is trading volume. So it is the total number of shares being traded at a particular period of time. So when a security is more actively traded, their trading volume is high. Now higher trade volumes for stocks means higher liquidity, better order execution, and a more active market for connecting buyer and seller. So whenever you are purchasing a stock, always look at the trading volume, whether the volume of the trades are high or low. The next is volatility. Volatility means how fast the stock prices moves up and down. Now on a particular day, the stock price of a company can go up and down. And if this change in the share price is drastic, then it means that the stocks are very highly volatile. And more volatile stocks are considered risky than less volatile stocks, because the price is expected to be less predictable and may fluctuate dramatically. The next term is short selling. Now in the stock market, you do not always need to first buy and then sell stocks. Sometimes you can first sell the stock and then buy, and this concept is called short selling. It is a practice when the trader sells shares first, which he doesn't even own at that time, and hope that the price of that share starts falling. The trader will make a profit by buying those shares back at a lower price. So let's say there is a company whose share price starts falling. So you can first here sell the stock at rupees 100, and later when the price falls to rupees 95, you can buy back that stock, and here the difference in the buying and selling, that is 195, is your profit. So a lot of people use the technique of short selling to make profits in the falling market, that is in the scenario when the share prices of companies are continuously falling. The next term is average down. This is an approach that is used by investors to buy more stocks when the share prices starts fluctuating, and this results in an overall lower average price for that share. For example, let's say there's a stock whose prices are continuously falling and you are not certain at what price you should buy that stock. So you can buy that stocks in different prices. So let's say you bought 10 stocks at rupees 100, and after few days the price of that stock fell and you bought the stocks again at rupees 80, and the price again kept on falling, and after a few days you again bought 10 stocks of that company at rupees 60. So here your average buying price will be the average of all the prices at which you bought that stock, that is rupees 80. And here as you can see that it is lower than what your original price will be. So average down helps investors when they are uncertain about the purchase price, or when the prices of stocks are fluctuating drastically. The next term is portfolio. A stock portfolio is group of all the stocks that you are holding. So let's say you are holding 5 stocks of HUL, 10 stocks of Maruti Suzuki, 20 stocks of Apollo Tires, 50 stocks of Titan companies. So all these companies are in your portfolio, and the portfolio shows the different stocks and the quantities that you are holding. And it is very important to build a good portfolio to maintain the risk reward in the stock market. In other words, you do not want to have all the risky stocks in your portfolio. If you have some risky stocks, you should also keep some safe large cap companies so that you can balance the risk and reward. Therefore, it is really important to make a good portfolio if you want to get consistent good returns over long term. And last and final term is dividend. So whenever a company is in profit, it can either reinvest that profit, that is, it can buy more assets, more profit, or expand in new countries, or it can distribute the profit among its shareholders. So this share of profit that is distributed by the company to its shareholders is called dividends. So let's say a company made a profit of 100 crores in an year, and out of 100 crores they decided to share 40 crores with its shareholders, and there are a total of 4 crore shareholders of that company. So for every share, the shareholder will get a dividend of rupees 10. However, an important concept to understand here is that a company is not obliged to give you dividends. For example, the growing companies who are reinvesting the profits fast in their business, they might not give you any dividend. On the other hand, big companies which are already established and matured and who do not need much money for their expansion, they might give a very good high dividends to the shareholders. A lot of government companies or utility companies, petroleum companies, they give very good dividends to shareholders, and this is also a way to get passive income directly in your bank account. So let's say you own 100 shares of a company, and a company is consistently giving a dividend of rupees 2 per year and also increasing the dividends every year. So this 2 into 100, that is 200 rupees, you will get directly in your bank account, and further as it keeps on compounding and increasing in future, this is a kind of passive income for you. So that's all for this video. I hope it was useful to you. If you liked it, please hit the thumbs up button and subscribe to this channel for more interesting investing videos. This is Kritesh signing off.